the Monday edition of Dividend Cafe, brought to you from absolutely beautiful Midtown Manhattan. Gorgeous spring day and a reasonably traditional Dividend Cafe Monday, in that there's, the 5 or 6 categories I always like to cover. We're going to cover a little bit from all of them. Nothing super exciting to report, and we'll kind of give you the update on the things that are happening around the world. I first want to say, if you didn't see or hear the Dividend Cafe from Friday, I would love for you to check that out at dividendcafe.com, wherein I look at what I consider to be the 5 unique factors behind the investment success of Warren Buffett. And there is, of course, as always, the video, the podcast, and the written commentary available for you at dividendcafe.com. And I think it's a topic that there's a lot of takeaways that really have nothing to do with Warren Buffett, that we use Warren Buffett's situation to extract some lessons that may be applicable to all of us. As far as markets themselves go, the market opened at the low of the day and was down almost 350 points, and then just very steadily increased throughout the day. It didn't hold at those lows in any of the market indices, and then by midday hit a high, and then it kind of just bounced around a bit and closed a little bit below the high of the day, but well off of the lows. To be honest, I think you're up nearly 500 points off the lows. But the Dow closed down, up 137 points, which is 0.32%. The S&P was up 0.09%, 9 basis points, and the Nasdaq basically flat on the day, up 2 basis points. Now, the story of the day was supposed to be this: Moody's downgraded U.S. debt. They had downgraded the credit rating of United States sovereign debt from AAA to AA1, which is essentially the same rating the Standard & Poor's, Moody's biggest competitor as a credit rating agency, gave the U.S. back in the summer of 2011. Fitch 2 years ago downgraded it 1 notch. So what Standard & Poor's did 14 years ago and Fitch did 2 years ago, Moody's did over the weekend. And I don't really want to belabor this point when I say this is about as non-newsy of a story as news stories get. If you look to the substance of the matter, that the U.S. is running high deficits and has been forever, that the ratios have gotten worse, that the level of national debt is higher. Certainly Standard & Poor's was onto these things a long, long time ago. And of course, bond yields remain very reasonably low, and appetite for purchase of U.S. Treasuries remains very reasonably sustained. Now, I'm sure there's some symbolic significance in the credit downgrade, but as far as it being something substantive to the actionable activity of bond investors or financial actors, I don't buy it for a second. Markets were down a few hundred points and then came right back and closed up. So apparently markets agreed. Even the bond market, the 10-year today closed at 4.45%, up 1 basis point on the day. It had been at 4.56% earlier in the day. So at one point, yields were up 11 basis points, but they closed up just 1. So I guess my joke is that Moody's could take comfort in the fact that markets responded to their warning for almost a half hour. And there we are. Okay, the top performing sector today, most market equity sectors were up on the day. Healthcare was up almost 1%, but energy was down 1.5%. There's a link to this at Dividend Cafe, but Walmart announced last week that they saw little choice but to pass along the impact of tariffs to consumers. And then President Trump tweeted over the weekend that they shouldn't do that, and he's going to be watching them. And I just want to point out Walmart has an average margin of 2.9% on goods sold. Japan ships $40 billion of automobiles to the United States per year. That's 1.5 million cars. That's 30% of Japan's total exports. And Americans like their automobiles. The tariff Japan charges on US auto imports is 0%, but I don't think the Japanese care for our autos that much. I don't know how a deal is going to get worked out with US and Japan on this, but I am told a deal is forthcoming and that it will very likely not focus around tariffs, since we don't pay tariffs to them on our exports of automobiles. But there's other factors at play, non-trade barriers, things like that. We'll see where this goes. Um, Definitely, this was believed to be one of the easier deals when President Trump changed his mind on his Liberation Day announcement back in early April, and it is not proving to be one of the easier ones. Uh, on the news front, we know that President Trump spoke with Vladimir Putin today. We believe the call lasted almost 2 hours. He did speak with President Zelensky of Ukraine afterwards, and the follow-up doesn't appear to be very specific or substantive, but just that both sides are agreeing to talk further about talking about some form of ceasefire and ultimately some potential off ramp. I don't want to make light of it. It is true there's nothing really to report, but there could be something to report of it going really badly. And President Trump announcing afterwards, I'm tired of the games. We're out. U.S. is done. That didn't happen. And so I think that is newsworthy. But yeah, we are a ways away from being able to announce that there's actually some sort of substantive conclusion. Speaking of substantive conclusions, um, late Sunday night, the conservative hardliners allowed the House budget bill out of the budget committee. They had blocked it as of Friday. Now, there's a long way to go to say that the House is going to vote for this, but let alone getting the Senate vote, let alone getting House approval of Senate changes. But the thing that could have killed it, not getting out of budget committee, didn't happen. And so once again, Speaker Johnson's had moved the ball, and they have not scored a touchdown yet, but they have continued to move the chains, if you will. I miss football analogies, and that one actually worked. There's not a lot to report on what was modified. Speaker Johnson referred to it as minor modifications that got the Rules Committee guys holding out to move forward. What we hear is that they are going to accelerate the timeline for enforcement of work requirements for Medicaid, and that there will be some more aggressive removal of some of these clean energy tax credits. So those are a couple of things that might be fiscally moving it in the way that some fiscal hawks might like. We're also told that the draft is moving to a $40,000 SALT deduction cap, not $30,000. But if it's true that they're holding a $200,000 income limit, that really is pretty moot. I don't think you're going to talk about very many people qualifying for it, let alone itemizing at all at that level. So I remain a little mystified what's going on there. Speaker Johnson's supposed to be meeting with the SALT caucus tonight at 9 p.m. Eastern. There is a rules panel hearing set for 1 o'clock in the morning, Tuesday night, Wednesday morning, with a 4-vote on the House desired for Thursday. And so we'll see. There's still plenty to happen between now and then. As things stand right now, it would not have the votes, but it obviously is moving towards the votes. But the final comment I want to make on this is just the irrelevance to markets of merely getting a bill. We are much more in a stage now of the bill itself. I know that there's a lot of drama on what Speaker Johnson is going to get done and not done, and are they going to get a vote, and who's holding it up, who's not holding it up. I remain of the position that they're one way or the other going to be getting a vote, one way or the other going to get a bill passed, and one way or the other not likely to have a bill passed that is going to meet the moment, and that there will be some disappointment in the final substance. I do hope I'm wrong, but that's my base case at this point, that A, they do get a bill, and B, it isn't a great bill. That's my presumption. We'll see if I'm wrong. Economic data I wanted to share that came in late last week. The producer price index had declined 0.5 percentage point in April. The year-over-year PPI is only 2.4%. Energy and food wholesale prices were down, but the core PPI was also down about the same. I think core PPI was down 0.4%, and the headline was down 0.5. So food and energy prices being down was only additional 0.1%. Goods prices are up a whopping 0.5% year over year. Services prices up 3.3. So the combined total wholesale prices are very much around where the Fed's target is. Now we go forward in terms of what to expect with the overall economic scenario. You had freight shippings up 275% last week versus the week prior. Not a big surprise given the removal of the US tariffs on China and vice versa that took place. So you had a lot of pent up demand that then accelerated in the wake of that announcement. Retail sales were up 0.1% in April. They're up 5.2% versus a year ago. And then Japan's economy contracted 0.2% last quarter, more than expected. And I just want to add that I don't think that's going to help Japan's leverage in whatever discussions and negotiations are going on. Moving on with more economic data, the NAHB, the National Association of Home Builders Sentiment Index, was abysmal. It dropped another 6 percentage points to 34. It's the weakest it's been in over 2.5 years. And it reflects a very poor present situation read and very weak prospective buyers traffic. The tariff issues around lumber, steel, aluminum have created issues for builders. 78% of survey respondents saying it's creating difficulties for them to price homes. Then the housing starts in April were only up 1.6%. That was below expectations and 1.7% lower than had been the case a year ago. But the far more important element of this is that single family starts are actually down 12% from a year ago. The total net number is only not down more because of multifamily starts, which are overwhelmingly in the positive. The Fed is sitting at a 92% probability of no change in the Fed funds rate at their June meeting next month. 8%, possibility of something happening. That's more or less the same as zero. But what I think is a bigger news is that there's a 35% implied probability of a rate cut in July, meaning a 65% cut of chance of no cut at all, even in July. And largely that reversed as the presidential reversal on tariff threats happened. The odds of economic distress in the market that the Fed would be responding to became less of a catalyst. So where we stand now by the end of the year is a 23% chance in the futures market of only one cut, a 38% chance of two cuts, a 26% chance of three cuts, and only a 7% chance of four cuts, with five cuts basically almost entirely off the table. So there's definitely been a repricing more in the 2 to 3 range versus the 4 to 5 range that had existed a month or two ago. WTI crude closed today a little over $62. Not much of a change on the day. Midstream energy stocks were up 2.5% last week. MLPs were up even more. They were up about 4.5%. The refiner stocks, the downstream segment, was up huge last week. Upstream was somewhere in the middle. But crude itself was up 2.5% last week, and it's sort of just floating there around $62 a barrel. There is a question in the Ask TBG portion of Dividend Cafe. It's kind of a three-part question that someone brought us with additional color about Warren Buffett. Rather than get into it all on the podcast, I'd say if you're interested in that, I encourage you to go to dividendcafe.com for that answer. Other than that, we're really going to see what happens out of the tax bill this week. We're largely, we're past the FOMC meeting. We're past earnings season. So yeah, we'll focus a bit here on what's going to happen with Congress. And in the meantime, pray for an otherwise boring week, but there's not a lot of boredom these days. Covered a lot of ground today. I'm going to leave it there. Reach out with your questions anytime. questions@thebahnsengroup.com. And that is me signing out with a lot of gratitude for you watching listening and reading this Monday's Dividend Cafe.